Hello, Aaron Ninnis here, your loan pro from Denver, Colorado, with another installment of How Much Mortgage Can I Afford? With the holiday season here, credit card balances for some folks are on a higher side than possibly they could be. So today I'm going to be talking about how credit card balances affect your credit score and how that might actually go into your qualification. As always, if you like the information, make sure you subscribe, like, or follow. Keep getting this information delivered to you every week. Otherwise, thanks for watching another episode of How Much Mortgage Can I Afford? Well, thanks again for joining me for another episode of How Much Mortgage Can I Afford? As I had mentioned, it's the holiday season, so happy holidays to everyone out there. I myself am a Christmas guy, but there are plenty of ways to celebrate whatever your beliefs are. Just a special time of year where really we hang out with family, and a big portion of the holidays is also giving gifts. Now, gifts cost money, and as such, sometimes we see credit card balances start to increase for individuals. And how that affects your score is something to think about, especially if you're looking to buy a home at the beginning of the year. Now, as an example, for putting into perspective, we're going to say you have a $1,000 credit card with $900 charged on it, and I have a $10,000 credit card with $9,000 charged on it. Now, it's very simple math to say I've got 10 times the debt you do. That's a true fact. But we are both using 90% of our credit card. As such, when it comes to credit reporting, we would be considered the same credit risk. We've used the same amount of our credit. So what it really comes down to is what we use as a term of credit utilization. How much as a percentage of your credit are you using? And as you start to increase over thresholds, and they're not set in stone, but roughly 30, 50, 70, 90% of your credit line, the score is negatively impacted. When you go to buy a home and you pre-qualify or get your application turned in, and let's say I'm the loan officer, when I pull your credit score, it is a snapshot in time as whatever was reported by the credit card themselves or the credit card company. So what that means is even if you pay off your card to zero, but you immediately go and start to add up additional charges, when the billing rolls over on that card, that is the actual amount that is reflected for scoring purposes. To give you another example, you have a $1,000 credit card and you put all your groceries and basic items, maybe cell phone and some utilities on that credit card. As such, the balance on that $1,000 credit card usually shows a balance at the end of the billing period of $800. When you get paid, you pay that credit card down to a zero balance. And then the process starts over. Well, in between the time of you paying it down to zero and then going back up to that $800 balance the next month, what you may not realize is that the credit card company is never telling the credit card or the credit bureau you've paid it down to zero. So month after month, it appears you have an $800 balance against a $1,000 credit card, or that you've used 80% of that card month after month, even though in reality, you are paying it down to zero. So something to think about is, one, keep your credit utilization low. Try to be below 30% on any credit card. Whether that was just watching how much you spend or even asking your credit card company to increase your limit, you're going to be utilizing a lower percentage. That is how you get the best credit. Second thing you want to do is if you have the ability to pay off credit cards or pay down credit cards before the bill rolls over, it's a good idea. Now, this works best if you're paying off the entire balance because when the bill comes out, you still have to make another small minimum payment. But the reality is that if you send that payment in right before the billing cycle ends, that is what's reported. So instead of showing that $800 in our previous scenario, if you paid it down to, let's say, $100 right before the bill rolled over, all of a sudden the credit bureau gets a report saying you only have $100 on the credit card and your score goes up accordingly. When we as lenders pull that credit report, that is a snapshot in time we use. You could certainly pay down that credit card during the process. We could do a rapid rescore, but we want to avoid pulling your credit as many times as we can. So watch your utilization over the holiday season. Keep your spending in check. And if you do use a credit card and it's something that you could pay off relatively quick, I urge you to do so. I know that getting points is fun and it's also a good way to pick up some extra cash. We use ours for vacation once a year, so I get it. But monitoring that utilization is a key part to having great credit. In fact, 30% of your credit score is based on that utilization. Hopefully that gives you a little food for thought about spending in the holiday season. If you have overspent, make sure you knock down those credit cards as fast as possible. You will absolutely benefit when it comes time to buy your home. Otherwise, thanks for watching this episode of How Much Mortgage Can I Afford? Happy holidays. Be safe out there. Enjoy your time with your family. And we'll see you in another episode of How Much Mortgage Can I Afford?